All right, let's get started. My name is Allison Rendelman, Team Lead of the Customer Success Associates here at YCharts, and I'm excited to introduce today's webinar in which our VP of Product Management, Caleb Eplett, is joined by Brian Portnoy, founder at Shaping Wealth and author of the best-selling books, The Investor's Paradox and The Geometry of Wealth. For today's conversation, we're going to delve into the world of behavioral finance and pick Brian's brain on how advisors can more effectively communicate with their clients during challenging market conditions. Before I turn it over to Caleb to get started, I wanted to note that we'll have a Q&A session with our hosts at the end of the webinar. So please, as you follow along, feel free to submit your questions on the left-hand side of your screen. Please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Finally, as always, a recording of this webinar is going to be made available on YCharts and sent to all attendees. Go ahead and take it away, Caleb.
All right, Allison, thank you. And thank you, everybody, for joining us today. I'm coming to you live from my home office, which 6 months ago was better known as my living room. But really excited to have Brian Portnoy on with me today. In addition to all the things Allison said about Brian, he's a great follow on Twitter. Always has some really valuable insights, as well as makes me laugh most days. So always good to see that. So if you want to go ahead and jump into the next slide there, Allison, we'll run through a quick agenda of what we're going to go through today. Brian's going to be kind of leading the conversation with us today about a really interesting topic, also one that's very relevant, right? So we're looking at making investment decisions in the midst of a crisis. We'll start by taking a look at kind of the emotions and thoughts that people are having. We'll move into decoupling expectations from kind of realistic outcomes and probabilities. And then lastly, talk about, some real world takeaways that we can have to incorporate some of this into practice. So let's jump right in. Next slide. And I'll let Brian kind of talk about what people are thinking right now and how we might be able to interpret that.
Great. Well, thanks, Caleb, and thanks everybody at YCharts. Very happy to be friends with so many of my local Chicago colleagues at that great firm. Yeah, so today we're going to talk about applied behavioral finance, and I put together some slides. Caleb and his team have put together some slides, and needless to say, things are relatively difficult right now in terms of making good investment decisions, but also on, money more generally for reasons that we're going to dive into. What I first want to do is just kind of level set or set the table for why making money decisions is as difficult as it ends up being. It's something that we struggle with. But the question is why? And there's sort of a three-step thing here. The first is that financial literacy and financial education in the U.S. is in a pretty sorry place. We tend to never learn about money in grade school, high school, and even in college when we learn about it, it's very quantitative. It's finance and economics. These are three famous equations, gold star for anybody who could recognize them. But the fact is that they're more or less irrelevant and pointless to how we make decisions about money. But nonetheless, that's how we learn. The fact is that we then, feel very differently. Fear, greed, envy, hope, joy, regret, shame. I mean, all of the deepest emotions that we have fit into our money lives. And money ultimately becomes this emotional lightning rod. And as a result, we just don't talk about it. For the most part, between husband and wife, parent and child, even in some weird ways between advisor and client, we're sort of on mute. So, what I've been building with my new firm and the types of conversations I have with advisors and their clients, I want to take the industry off mute. I want to kind of create a place where we can have real conversations about money, cut through some of the technical jargon, recognize that this is a very emotional topic, and get to a better place, not just in terms of reconciling our feelings about money, but really the specific decisions that we must make skillfully with regard to our portfolios, our bank accounts, and so forth. So, behavioral finance is a field that I've been passionate about for, a number of years now. If we could switch the slide. This is my favorite quote of all time about behavioral finance. I mean, I'm sure lots of people on the call are familiar with Kahneman and Tversky and Dick Thaler. And, there's a lot of complicated stuff out there, but I love the way Professor Thaler just puts this bluntly. People aren't dumb. The world is hard. Our brains were wired for a bunch of evolutionary reasons to find all things money really difficult. And so when we look at some of the kind of basic rules of the road that we see on the next slide, what we quickly recognize is that simple doesn't mean easy. It's a point that a lot of people in financial Twitter like to point out, and it's always worth stressing that simple is not easy. I mean, just go down this list of basic, think everybody in the call, you get asked for, financial advice all the time, I'm sure. And if you were just doing it in passing, these rules of thumb or basic ideas are probably what you would recommend. Buy low, sell high, diversify, save more and spend less, have a long-term perspective, do your research, know what you're doing, and sit tight most of the time. The thing is, the human brain is wired to do the opposite of all of these. So I'm not going to go through, each bullet point here could be an hour-long conversation, but, because of the cycle of greed and fear that we've had, hardwired into our brains for roughly 130,000 years or so, we buy high and sell low. We get excited when the market's up and we buy, and we get really scared when the market's down and so we sell. We dislike diversification intensely, because the real definition of diversification is that something in your portfolio always stinks, and you're always going to feel compelled to move things around when there's something there that's underperforming, and so on and so forth. Things get even harder in a crisis. So when we move to the next slide, we recognize that the previous slide was just sort of a generic overview of like why this is so hard, but we also have to appreciate on top of that our minds are to some extent time machines, and we're always zipping around between our imagination and our memory and being present. And in times of crisis, times of emergency, and so it could be something as terrible as a car crash, could be something as bad but a little bit more distant like a market crash. When that happens, time in our mind compresses, and we find it really, really hard to focus on the future. So in normal times, when there's not a lot of volatility, there doesn't feel like there's an emergency, we can focus on the future. Just from a neuroscientific point of view, however, and this is a physical thing, it's just not something we can wish away. This is sort of the way that our minds are wired. When volatility strikes in all of its different forms, when there's danger in front of us, boom, like time collapses, and we make it, and it's much harder to focus on the future. It's why having a financial plan is so critically important, in no small part because it's a time anchor. It allows us to maintain a longer term perspective. And even during times like March into early April, when things looked and felt quite awful, we're able to at least have something on a piece of paper, at least something that can be part of a conversation where you say, okay, when things were calm, this is what we talked about. Let's try to focus on this. But that time compression dimension is critically important, and it's one of the reasons why decision-making during crises is like so critically important. Next slide on volatility. I think YCharts put together some stuff. Caleb, you want to talk about this?
Yeah, thanks, Brian. So I'm going to jump in here. I'll probably do this a couple of times, but I thought that this chart really kind of emphasized the point that you're making there. What we have here on the bottom is the VIX, kind of the de facto way to represent volatility in the markets. And on the top of the chart there, we've got the S&P 500. And if you look at, kind of that phenomena of when volatility is exceptionally high, and you think about that framework of thinking where you're going to be the most short-sighted in those time periods and potentially selling out of your investments, you can see that typically correlates with downtrends in the market. So you would be selling those lows. Further, I guess with the gift of hindsight here, someone more forward-looking would see these as great buying opportunities. when that volatility strikes. But I think, and as we jump into your next slide, you can talk through some of the emotions that go on with this, but it's so hard to think that way in the moment, right?
Yeah, this is a slide I had put together, or a table I put together for one part of the geometry of wealth when I was talking about our emotional reaction to market declines, because it's very easy to be like an intellectual purist and to talk about, value investing and buying on the dip. And, the deeper the decline in the market, the uptick we see in Warren Buffett quotes, and everyone's supposed to be greedy while everybody else is fearful, and vice versa, which is actually not the best advice in the world, but I'll leave him out of this. When the market's down a few points, we don't tend to do much. We notice a little bit more because our brains are wired so precisely for sensing danger. I mean, it could be physical danger right in front of us, or it could be more of a kind of intellectual, wait, something's happening in the world that seems wrong and it's impacting me. Whatever the manifestation of that danger, we become very alert to it very quickly. So when the market is down 5 or 10%, we do take notice. We do feel uncomfortable. This is not science here. So when you look down the left column at those levels, this is just my experience over the last 20 plus years of talking to investors and just thinking about my own experiences. When you get down to double-digit losses, it begins to feel really uncomfortable. And that urge to do something really kicks in. So down 10, 12, 15%, hey, this isn't working in the portfolio, this particular piece. As Caleb said, it might be time to buy more of that piece that quote unquote isn't working, but most of the time, that's not what anybody does, including professional money managers. And then it goes on and on beyond that. When you get down to 15, 20, 25%, most of us, most of the time, feel compelled to to do something, to sell something, to reshape the portfolio. So we feel like we're fighting back against this, faceless danger that is market volatility, which kind of just raises the issues of how we set expectations for our clients, for ourselves and for our clients. I know there's some friends on the call who will recognize this cartoon. It's maybe my favorite investment cartoon of all time. One guy says to the other, "We didn't underperform, you over-expected." And, the idea is simple but powerful, which is that it's our jobs as advisors and educators and service providers to help manage expectations so that when things go awry, we can at least say, hey, we've prepared for this, we've thought about this as a potential outcome, and then we don't panic, we don't make poor decisions. There's an educational opportunity just on the topic of the relationship between risk and return. So when we go to the next slide, I think we generally in our industry, and what people would say in the general public is, the more risk you take, the more return you'll be able to make. And there's something correct about that, but there's also something wrong. On the one hand, it's true that if you don't take any risk, if you just put your money under your cash under your mattress, it's not going to grow. And today's not the day to talk about inflation or purchasing power or anything like that. You'll effectively lose purchasing power. But if you don't take any risk with your capital, it's not going to grow. And so when folks say, hey, no pain, no gain, that's generally true. The further you go out on the spectrum, and we think that more risk leads to more return, that's actually not only, it's incorrect and it's dangerous. It's actually some of the worst advice that advisors give their clients. And why is that? It's because the further you go out on the risk curve, and switch to the next slide, the more variable the outcome is going to be. Now, to say more risk, more return, or no pain, no gain, like those are pretty good bumper stickers. They sound good. They're easy to say. The line that more risk equals more variable outcomes, that's not particularly interesting. It doesn't roll off the tongue. But in point of fact, the more risk you take, the more likely it is you're either going to do really well or you could potentially lose all of your money. And so you'll see at the front end of the graph the sort of no pain, no gain in the southwest corner. If we could advance the slides. There we go. So you take limited risk. There's really no upside or downside for the matter. The capital just stands there. So on the opposite end is where I think we have an amazing coaching or educational opportunity, because our clients are looking at Tesla or Peloton or Spotify or big tech and just seeing these stocks sort of, it seems like they're doubling every week. And sometimes it's hard to, sort of not be in the game when you see others being, getting richer by owning these stocks. But this is really a teaching opportunity to say that, yes, sometimes that works out and other times it doesn't, and that there's a range of opportunities that are going to be kind of appropriate for, where you are in your life cycle.
So Brian, as we jump into the next slide here, I saw another opportunity to use some data in YCharts to really hammer your point home. We're used to, when we look at a chart and see different portfolios or different risk models on there, usually the charts are always over a long time period and they're almost always trending up and to the right. And the chart with the value that is the highest, to the right is usually that more risk on portfolio, which leads to that thinking, right, of, if I take more risk, I'm going to have higher returns over the long run. We kind of broke that analysis down a little bit differently in this chart. So each of these three different lines on the chart represent a different kind of risk model portfolio. So at the top, we have a 80-20 portfolio, so 80% equities, 20% fixed income. In the middle, a balanced 50-50 portfolio. And at the bottom, this is a 20% equity, 80% fixed income, so more of a conservative portfolio. And the actual charted values there are the trailing monthly returns. And within those red boxes, you can see the max and min for each of these portfolios over the last 10-year period. So if you go ahead and click one more time, Allison, you can actually see the spreads between these different ranges, right? So that very aggressive portfolio or aggressive profile portfolio at the top there, that's going to be the one that if you're looking at that traditional chart comparing three different strategies over a 10 or 20-year time period, is going to have the highest returns. You can see the spread between the lowest or the worst and the best month is a whopping almost 45%, a huge spread there. And you can see as you move up this ladder of risk, the amount of kind of volatility or the spread between your best and worst month almost doubles every single time. So I thought this was just a good way to, further emphasize that point that you're making and really hammer that home.
Yeah, if one of our core jobs as advisors, consultants, educators is to manage expectations, there has to be a component to that where we bring real history into the fold and we show what's possible. What I actually like about this, on the one hand, they kind of look like the same squiggly line, but the y-axis is dramatically different for each. And so the fact that there's a 40 plus, 4,400 basis point spread between best and worst when you have more of an equity tilt, that might be super appropriate for, who the client is and their age, and their risk tolerance and what they want to achieve. But, there's a kind of a Goldilocks sort of, just not opportunity, but sort of a need to hit that Goldilocks moment where you're not over-promising or under-promising. And it's something that, in my experience, advisors can struggle with. So, speaking of, return expectations, the next slide just has a data point that I love. Natixis does, some great annual reports on this. This is taken from their 2019. They do an annual thing where, among other things, they survey high net worth investors as well as financial advisors, and they ask what do they think their portfolio return is going to be on a going forward basis. It's not a specific take on asset classes or anything like that. It's like, okay, what do you think your portfolio is going to do? You can see a really big number at the top, and that number that's a real that's a real return. So the typical investor, and these were high net worth investors, I think there were 3,000 or 5,000 that were surveyed. They expect about 13 to 14% a year from their portfolio. which is just a crazy high number. You know, wherever the 10-year was when they, you know, asked this question, it doesn't even matter. That's a very unrealistic expectation. Advisors a lot more sober, but still on a nominal basis expecting 7 to 8% with bond yields, you know, south of 1 or between 1 and 2. You know, you're asking a lot from your equity portfolio. So everybody's a little bit optimistic. And then from client relationship management, like how you form trust, how do you have these coaching style conversations? When you have a 600 basis point difference in return expectation between what the investor thinks is going to happen and what the advisors thinks is going to happen, it's really a recipe for disaster. I mean, it's a good way to destabilize your client relationships when you're very far away on that score. And, you know, for as much as we can talk about saving, spending, insuring, giving, that portfolio return is super, you know, that's going to be important. That's going to be as central to the conversation as any other number. So I think, let's see, what's on the next slide? More return expectations or return achievement, right? Yeah.
Yeah, so we took a chance to put some data here in some charts again to maybe further validate or test some of the you know, assumptions that you've made there. And sure enough, you know, what we did here is we looked at, and this chart's a little bit complicated at a glance. You know, the top half of this chart, or the top portion, is looking at S&P 500 trailing 1-year returns. And it's also on that same axis plotted the trailing 1-year consumer price index, right? So the kind of inflation adjuster for that data. And then we've got the average. And if we take that data back to 1975, you can see the average market return is about 9.5%, and the average CPI data is about 3.7. So when you kind of net those out, you do end up right around 5.5, 5.6% there for that average kind of trailing annualized return once adjusted for inflation. The interesting thing here, though, is this also shows you how time affects the situation, right? So I know, you know, as we were looking at that slide a couple pictures ago, you could see the different volatile periods and how they really affected the, you know, maximum downside and upside of those different portfolios. So when you're invested seems to have a really big impact on this, but also for how long you're invested. So on the bottom portion of this chart, this is just the spread between the two. So this is essentially the inflation adjusted returns trailing on a monthly basis. And if we capture any small period within this chart, we're going to get a much different average than we do over the long run. So, you know, I think it's just interesting to look at this, and it makes me ask you, Brian, you know, how do you think about, you know, timing and when people are invested, but more importantly, how long they can stay invested when you're making these assumptions for what portfolio returns are sustainable over time?
Yeah, so one thing on this slide, and then I want to present some even a longer historical time series. The top graph here I like because it shows the blue line is pretty extreme in terms of its swings. North of 30%, south of, you know, negative 30%. And so, you know, we get to that long-term nominal and real average, the real average of, you know, between 5 and 6%, which squares with, you know, what we know from market history. But, you know, sort of the ability to be in the market when it's moving up and down is something that some people can handle quite well and others don't. And so expectation management is very much going to center around this, you know, up and down quality. So this is from 1975 to the present in the geometry of wealth. I ran some other numbers that looked at I didn't put it on the slide, but it's the full S&P series. So it's 1927 or 28 through, I think, 2017. And these are rolling 1 year periods. So rolling 1, rolling 2, rolling 3 measured on a monthly basis. So if you think about every rolling 1 year period measured monthly, you know, January to December, February to January, and so forth from 1928 to the present, that first dot on the left, there are thousands of data points in there. So it's a pretty robust set of numbers that we're looking at. What's interesting here is that you just take the quote-unquote average of what the market has done over the, you know, last nearly 100 years. The answer is about 10%. And if you ask, I think, a typical investor, oh, what's the stock market do? Like, what's going to give you over time? Oh, about 10%. that's fine, but it's also very misleading. When we look at the next data set, now we're looking at the variation around that average. And what you see pretty starkly is that in those early years, year 1, year 2, year 3, is that the difference between a good year and a bad year is thousands of basis points. You can have up 30, up 40 years, down 30, down 40, down 50 periods. It's really not until you see things smooth out in year 6, 7 forward that there's a more stable, a more predictable range of returns. Now, granted, I don't want to be misleading because there's still a very wide gap between top and bottom performance years in those numbers in years 7, 8, 9, and 10. But we do approach those historical averages if we can hold our portfolios for that longer period of time. So in this case, I think the conventional wisdom is pretty good, meaning that if you're going to be in equities, having at least a 5, if not a 7+ year time horizon makes a lot of sense, or else you can get trapped into a really volatile situation and lose a lot more money than you either expected or that you wanted to. Let's move on. One of the things I've been focused on in terms of, working with groups on managing expectations is just the recognition that, beyond, somewhere between the market broadly defined and individual stocks where there's always an interesting story to tell, there are factors. There's, big cap versus small cap, growth versus value, and so forth. And here too, expectations management is a lot of the game of sort of surviving and being able to stick with the portfolio that you own. So I think the YCharts guys put together a pretty cool looking chart where we can see on a number of different factor metrics sort of what did well versus what did poorly. And there's a couple things to note. Number one, quarter over quarter, year over year, impossible to predict what's going to do better or worse, which leads to, sort of advice about having a diversified portfolio. The second thing is that when you think about it all in, a lot of the conventional advice you get from traditional finance in terms of a small cap premium, a value premium, the value of investing overseas, the last few years have been really tough for the quote unquote smart people. It's really been about buying, it's been buying U.S. big cap growth stocks that have driven the market. So if we can, so the growth has beaten value, large cap has beaten small, has trumped small cap. Keep going. U.S. markets over international. I joke everything over commodities, but commodities have just stunk. But you think about all the academic books that we read about diversification. Commodities have been just they're a big part of that story. But if you look over not just these quarter-long periods, but the last 10 years or so, it's been it's been a really tough stretch to make excuses for why you have commodities in your portfolio, and then alternatives. Which is, a field that I've worked in for, more than a decade, where we're looking to have higher returns for lower risk or just something different that diversifies our portfolio. Again, big cap U.S. growth stocks have just beaten the pants off of many alternative strategies, both liquid and illiquid in hedge fund structures. So managing expectations around this is very tough. It kind of leads to advice around diversification, and having this sort of data I think is kind of super helpful in telling the story. Otherwise, it's just words. All right, let's okay. A treadmill. What's going on with this? I want to kind of just wrap up by talking about I've said the phrase managing expectations probably 10 times too many already. But that's a subset of this larger notion of goals. And, our industry has evolved towards something called goals-based wealth management. and those of you who have read my stuff know that I go on and on about sort of the social psychology of happiness. And there's this really powerful notion from social psychology known as hedonic adaptation or the hedonic treadmill. And basically what that says is that a few things. One, the human mind is not very good at predicting what's going to make us happy in the future. So yes, winning the lottery might make us happy, but in some cases it doesn't. There being something tragic happen that might make us sad, but we aren't always accurate in that. And even if we can predict kind of the emotional outcome we're going to have from those events, both the duration and the intensity of what we feel really very rarely maps to what we think it's going to. So even when good things happen, the happiness that you feel, it's less intense and it's shorter than you would imagine. And same thing with unfortunate events, with tragedies. Yes, we're sad, but not as sad as we expect to be, and also for a shorter period of time. And this gets to, I think one of the challenging things with the advice business these days in the grandest sense, which is sort of how are we helping our clients achieve happiness? How are we helping them think about the goals they want to achieve? And how can we accept the fact that we are just very much focused, from a high integrity point of view of helping our clients achieve goals. But when they achieve those goals, they actually tend to be not much happier than they were prior. One of my favorite quotes from one of my favorite shows, Don Draper, happiness is what you get right before you want more happiness. And I think we all intuitively understand that, because once we get toward and achieve a goal, we basically say, well, what's next? And if maybe the overarching theme today is managing expectations, we need to accept that the brain isn't wired to be happy for very long, even after we've achieved what we said we want to. The next slide reflects a study that I read once and I find just absolutely fascinating. Basically, over the course of the 1970s, 80s, and 90s, some researchers asked thousands of American families a question. In order to live in reasonable comfort around here, how much income per year do you think a family of four needs today? And so, those are dollar figures on the left. The absolute level isn't particularly important. So every few years they would ask this, and those aren't the answers. That's the median income of the families that were polled. Well, they asked the question, well, what would it take to make you happy? What would it take to make you comfortable? The next slide shows the answers. It's always a little bit more, okay? If you think about kind of the cadence here, in year 1, year 2, all the way through year 8, no matter what a family's income is, the level that was going to make them comfortable, where they feel like they're going to have made it, is always just a little bit more. And I think one of the things I see advisors struggle with is maybe less satisfaction from their clients than they would hope and expect. But the fact is that, we are wired to, engage in life's experiences this way. So just leave you guys with a pretty basic equation behind which there's a lot of fancy science and go to the next slide, please. This is the recipe for happiness, and why managing expectations is so important. So if we look at positive psychology, social psychology, a lot of that boils down to the idea that when outcomes or reality exceed our expectations, we tend to be happier. And when outcomes fall short of what we expect, we tend to be sad, or at least less happy. And this keeps going on in a cycle year after year, decade after decade. And so to the extent that, where the cutting edge of financial advice is these days is going beyond, move to the next slide, please, going beyond just selling and investing and building portfolios or even planning, and more to a holistic planning and coaching framework. This ability to think broadly, not just about the market and our portfolio, but more broadly about what our clients' expectations are. there's actually a ton of amazing work that we can do. So one evolution of this is just recognizing, you could go to the next couple lines, please, that, what this industry was going back 30 or 40 years was more or less a brokerage business. It was about capital markets access. It was about selling stocks and bonds and other financial products. It wasn't until that long ago that most people did not have access to the capital markets. It cost a large amount of money to buy and sell a security. That amount now is effectively zero. And then, we've evolved from there into a service-based industry where, we help plan for people's futures, and that's great. That's where the bulk of the industry is. But there's sort of a next level, I believe, which is that these are very noisy times. Human beings are processing more information and more choice than at any point before in recorded human history. And this notion of decision fatigue and choice overload are kind of legitimate social phenomenon. They have physical consequences for our bodies. And so our ability to provide a calmer and more directed experience, I think, is what is going to distinguish kind of the real winners in the wealth management business from everybody else. And another way of putting it, for those who have either read or seen Simon Sinek's TED Talk, Start with Why, this notion that, well, the great marketers don't really focus on what they're selling you, or even sort of the process of putting it together and how special or unique their process is. The firms that really capture our attention are the ones that share with you what their purpose is and connect with who they are and who you potentially want to be. So I think these are kind of messy but exciting times in the industry, because we're bringing in a lot of applied behavioral finance, a lot of social psychology, some neuroscience research to really not only do better for our clients, but fortify our own practices in a way that we can maintain a moat that really can't be assailed by other technologies or other advisors.
I think that's great, Brian. I've got a question for you here on this slide too. So I think a lot of people listening in right now, or a lot of advisors out there, would agree with you 100% that getting to the far right there with their practice would be ideal. What are some tangible steps that people can take to transition their practice in that direction when their clients might be used to the things, maybe in the middle here?
Yeah. No, it's a good question. It's sort of the $64,000 question. The first thing I think an advisor needs to grapple with is how much do they feel responsible for their clients' overall wellness, not physical wellness or even emotional wellness, but financial wellness. And to the extent that the answer is yes, and look, 99% of the advisors, thousands of them that I've met over the last however many years, they care passionately about the welfare of their clients and their clients' families. So to the extent that, that's what they care about, I do think that being able to engage clients on a deeper conversation about what their goals are, how they're going to achieve them, what they might not be thinking about, is just, it's just critically important. If you're just focused on the portfolio, or maybe, beyond that, just a very simple financial plan, that just says, hey, I want a new house, I want to save for college, I want to have enough money to retire. That's good, but in some cases it's not going to be good enough, because there's a lot of price competition and there's a lot of other service providers who are coming into the industry and not having that more robust conversation. And I think the headwinds are going to get even stronger, precisely because, if you think about, the generations who are very large in number and don't yet have a lot of money, but will, in terms of their own earning power as well as inheritance. So you think about millennials, Gen Z, and those cohorts, they live in the experience-based economy. They know how to Google. They know what the cost of things are. And so they're going to be asking hard questions of someone when you say, hey, I'm going to charge you X% for the advice and Y% for the products that, help me execute on the advice. The numbers are crawling or are growing smaller with every passing year. And that competitive moat is being eroded by other competitors as well as technology. So being able to have a more fully engaged conversation about what really matters in life and where money fits into that, I think there's a lot of different ways people can begin to prepare.
I think that's great. And I think this has been great in general. Learned a lot myself. I'm sure a lot of other people have too, but I'm sure there are also several questions. So I'm going to turn things over to Allison to go ahead and start collecting questions and maybe kick off our Q&A here.
Yeah, thanks so much, Brian. I just want to say for giving that excellent demonstration, and Caleb for leading us through the discussion. Before we jump into the Q&A, I just want to reiterate that a recording of this webinar is going to be made available on the support topics section of YCharts in case you want to review anything we went over or to share it with your colleagues. We'll also be sending a copy of this to all attendees in the form of an email. So now, I'm going to jump into the Q&A, and for those of you still with us listening, feel free to use the left-hand side of your screen to ask any questions for Brian and Caleb. I'll go ahead and start with one here. Caleb, I know you just had a question about goal setting that you wanted to kind of kick off with.
Yeah, I did. So I actually submitted my own question early on. But, this kind of leads or follows off the question that we just talked through, Brian. But, goal setting seems like such an important part of financial planning especially, right? And if you're talking about some of the expectations that goal setting can create and those being hard to live up to, how do you as an advisor set goals with your clients or do something other than set goals with your clients that still gets them excited about working with you and looking forward to the future?
Yeah. So I knew the question was coming, and I said before, it's a great question. So I continue to think it's a great question. So there's a problem with goals that the industry doesn't like to talk about at all. And let me try to give a very brief answer to why that's so. Because what's happened over the last 5 or 7 years is that we've moved to a quote unquote goals-based wealth management industry. And the question is, well, what were advisors doing before? And the answer was, well, they weren't as focused on the plan. They were maybe more focused on product sales. As we go into this goals-based phase, what we don't realize, number one, is that or most folks don't take into serious consideration that hedonic treadmill exists. And the achievement of goals is not as enjoyable as people make them out to be. Another nuance I put in there is that when we talk about goals, that's encapsulated by what you want to do, but that's very different from purpose, which is who do you want to be? And I think everybody's on their journey. Everybody's figuring out not just what they want to do, but who they want to be. And in my writing and in my coaching, I really like to put purpose prior to goals, and then goals lead to a lot of specific decisions. But when we think about the things that really matter to us that enforce or reinforce or even help us adapt our identity, the things like our attachment to community or our sense of autonomy in the world or the passion that we bring to our work or our vocation, those are deeper issues. Those aren't goals. Those don't have deadlines. They're never really achieved. One thing I try to coach advisors on is how can you concretely, specifically attach purpose to goals? Because purpose is really the bedrock. It's the cornerstone of the process. Goals come and go. Purpose doesn't. Yeah, your identity can change over time and you can become a different and hopefully better version of yourself. But if you can articulate that before you articulate what your specific goals are, you're going to be in much better shape. And it ends up that a lot of our goals come from scripts that we just take from somebody else. Like, what's the big script? The script is, well, you work for 40 years and do something super enjoyable until you stop working and then do something else. Like the retirement script is it's so powerful and prevalent. We don't really give it much extra thought. But the fact is, lots of people don't want to live that script. And I think not to say that people don't want to have money at in their later years, but there are plenty of people who do not want to just sort of park themselves in a job for 40 or 45 years so that they can gain meaning in employment, so they have enough money to stop having meaning from their employment. There's lots of other ways to cut it, and I think advisors are in a fantastic position to push their clients a little bit on kind of what path they really want to take as opposed to what path it seems society wants them to take.
Yeah, that's great.
Great. Thanks, Brian. I'm just going to come with another question here. We have one from Will, and he's asking about if you have any advice for today's advisors on how to communicate regarding the decoupling the market from the economy.
Okay, that's a tough one. Well, this is where, the data that I presented, some of the data that Caleb presented, I mean, I'm not going to go so far that I know it's what people say. It's something people like to tweet out about in terms of, the market and the economy have become detached from each other. I don't know what that means, let alone, how you would evaluate something like that. The thing is, markets do lots of crazy things. One of my mentors in life shared with me the insight that the market will do whatever necessary to screw over as many people as possible. And the fact that you've got this bifurcated market of big tech and COVID friendly stocks that are doing well, and a lot of other sectors that are not. The fact is that there are some conventional wisdoms that we talked about at the very beginning in terms of being diversified, in terms of dollar cost averaging, in terms of having a responsible spending plan and so forth, that while on the one, those are hard to do, but the job of the advisor is to serve as coach and trainer for the couple, for their family, for the generations within the family to get to that better place. Thinking of yourself as a coach as opposed to an advisor is actually a pretty empowering pivot because people love coaches. You think about the best athletes in the world, they have coaches, and it's not because they're bad at their job, quite the opposite. They're the very best, and the coaches sort of bring them down when they're too high and lift them up when they get a little bit low. So trying to describe this economy is a bit of a fool's errand in my point of view, in the near term. At the other end, market history can be very powerful, and we have to use all of that to tell a story that's going to, sort of help our clients, be comfortable with where they're at.
Just to touch on that a little bit too, Brian, I think it's funny. I hosted another webinar maybe 3 or 4 months ago, right? And the question was very different because the market was seeing some turmoil. So It's interesting how the investor's memory sometimes can be so short, during these volatile times, just like maybe how far they're looking out into the future. But it's probably not too hard to look back and remind them that that diversified portfolio protected them from a ton of downside, as far ago as February.
There's nothing, I think most people on the call probably take this notion of diversification to be simple and intuitive, and it's actually neither. There's a lot of psychology that's attached to owning it and sticking with a diversified portfolio that the industry has never really given a lot of great effort to explaining and introducing and updating with our clients. The fact is that because the S&P 500 in particular, the quote-unquote market, has beaten most other asset classes, whether it be small caps or international or, whatever, for such a long period of time, advisors get the question, well, why can't I just buy spiders? Because you're not doing anything of value anyway. And some advisors say, no, this is actually the broader program that we're on, and here's how we're helping you achieve your goals. And then there are some advisors who get kind of flummoxed because they stay within that narrow market-focused lens. And everybody, to your point, is focused on what happened in the last week or two, or maybe the last month, and just playing catch up with trying to explain why the market crashed in March and rebounded so sharply in April forward. There are better and worse explanations, I'm guessing. But if you see as an advisor your main role being a markets guru and an economist, you don't have much of a business ahead of you. Nobody does that particularly well. And there are other better things to do with your time and your client's time.
Well said.
Great. So we have another question here. This one comes from Ara. What are some of the key trends you're seeing in the advisor space now that you think a more behavioral finance could help with?
Yeah, it's really the pivot toward coaching that I referenced on that one slide with the the park bench facing out into the ocean solemnly. There's been this evolution over the last half century, from brokerage to investing to planning. There's been a couple waves of behavioral finance that have occurred along the way. It was a very unknown and academic exercise for a few decades. I mean, Kahneman and Tversky now, they just roll off the tongue, but no one heard of these guys before 10 years ago. And now, everyone's got Thinking Fast and Slow on their shelf. No one's read it, but it sits there and it looks really good.
We all started it.
We all started it. I actually finished it. But in any event, the cool thing, and I call it behavioral finance 2.0, is that there did come a point when there were enough critics who said, okay, stop telling me how screwed up we all are and make this practical, that there are folks, and I think I'm one of them, who have tried to, call it, create applied behavioral finance, where number one, you recognize that we're all wired to make pretty awful decisions, and that's fine. Like, we're kind of in this together. We're not dumb or irrational. We're just normal. And as Thaler says, the world is hard. And so now it's a question of like, well, what technologies, what educational programs, what other content or engagement can you create that takes the applied behavioral finance, the stuff that we're going to see if it actually works to create better decisions and outcomes, as opposed to just saying, oh, let me tell you about availability bias and confirmation bias and recency bias. I mean, at this point, that's kind of cute, but it's a waste of time. It's like, well, how can you help me? I'll give one very specific example, something I'm working on with a client right now, which is the difference between decisions and habits. Those are two different things. And I would say, all things considered, it's better to have good habits versus good decisions. Decisions, they drain glucose from our minds. They sap energy from us, and we do get overwhelmed. That decision fatigue phenomenon is a physiological, real thing. A habit, by contrast, is something that we don't really think about. Very few people think about, or I should say, not think, decide to brush their teeth in the morning and in the evening. They just do it. It's a habit, and it doesn't take any energy from our minds. There are so many positive habits in our money life, with investments, with saving, with spending, with borrowing, and so forth, that we can begin to instantiate in our client practice. But we're just getting started on that. This notion of advisors teaching their clients better money habits it makes sense. I think it's intuitive, but it's relatively brand new in its execution. And it sort of brings all those threads together in terms of how the industry has evolved, the maturation of applied behavioral finance 2.0, and then decision sciences from other fields all coming together to create like sort of a perfect storm for advisors to become proper coaches to their clients.
Well, thank you so much. Thank you, Brian, and thank you, Caleb, for covering these questions. And thank you all for attending today's webinar. We always appreciate any feedback that you might have for us. And if you have any questions regarding what we covered today, please feel free to reach out. Thanks again, everyone.
Thanks.
Hi, everybody. Thanks again, Brian. Great stuff.
Yeah, thank you, Caleb.